Hello traders, welcome back to day 28 of our trading podcast journey. Today we are going to dive into something that every trader should be aware of, the economic indicators and how they can play a crucial role in shaping trading decisions. Economic indicators are like the pulse of the economy. They can give us insight into what might happen in the markets, providing useful hints about upcoming trends or shifts. By understanding these indicators, you will be able to make more informed strategic trades. So let's explore which indicators are worth watching, why they matter, and how they can impact your trading decisions. To start, let's break down what we mean by economic indicators. Essentially, these are reports or data points that reflect the health of a country's economy. They are released by government agencies or private organizations and can cover areas like employment, inflation, GDP growth, consumer spending, and much more. Indicators can typically be divided into three categories. Leading indicators, these give hints about where the company is heading. Lagging indicators, these show trends based on past events reflecting historical changes. Coincident indicators, these represent the current state of the economy. In trading, understanding these categories and focusing on key indicators can provide valuable information on market sentiment and potential price movements. Let's look at some specific economic indicators that are commonly used in trading. This can give you insight into the economy's strength, consumer confidence, and more. Gross domestic product, that is the GDP. GDP is one of the most widely monitored indicators because it reflects the overall health of an economy. A growing GDP suggests economic expansion, while a shrinking GDP points to potential contraction or recession. How it impacts trading? A strong GDP report can be positive for a country's currency and stock market, while a weak report might signal economic trouble. Employment data. The monthly non-farm payrolls (NFP) report in the EU is closely watched because it reveals the state of employment. A high job creation rate indicates a healthy economy, while decline can signal a slowdown. Consumer Price Index, that is the CPI. CPI is the primary measure of inflation. It tracks the price changes of goods and services over time. Rising inflation can signal economic growth but can also prompt central banks to raise interest rates to keep inflation in check. Interest rates. Interest rate decisions by central banks like the Federal Reserve are significant event for traders. Changes in interest rates affect borrowing, spending, and overall economic growth. Retail sales and consumer spending. Retail sales data shows the level of consumer spending and is a good indicator of consumer confidence. Strong spending suggests that people are confident in their finances, which can boost the economy. Now that we know which indicators to watch, let's discuss how to incorporate them into your trading strategy. Align with market sentiment. Economic indicators are powerful in shaping market sentiment. By paying attention to releases like GDP and employment reports, you can anticipate how the market might respond. For example, if a strong GDP report is expected, you might look for bullish trends in the currency or in the stock market. Timing your trades around key reports. Economic indicators are often released on a regular schedule. Knowing when these reports are coming can help you time your trades. If you are day trading, for example, it may be wise to avoid entering positions right before a major report, as markets can be highly volatile during these times. Pair technical analysis with the economic data. Using economic indicators in combination with technical analysis can improve your chances of making successful trades. If your technical analysis suggests a buy signal and an upcoming economic report aligns with that sentiment, you might feel more confident entering the trade. Central bank policies and announcements often go hand in hand with economic indicators, and they can have a massive influence on the markets. When a central bank raises or lowers the interest rates, it's usually in response to economic indicators like inflation or the unemployment. Traders often closely monitor central bank meetings and announcements because they can signal future economic policy changes. One helpful tip is to create or follow a calendar of major economic events. Many platforms offer economic calendars that show the schedule of important reports, interest rate decisions, and other key events. Having a calendar helps you plan your trades and stay aware of potential market moving events. So, let's recap today's main points. Economic indicators like GDP, employment data, and inflation are crucial for understanding the market sentiments and making informed trading decisions. You can incorporate economic indicators into your strategy by aligning trades with market sentiment, timing trades around key reports, and using them alongside technical analysis. Central bank announcements are directly related to economic data, and understanding this can give you insight into potential market shifts. Building a calendar of economic events helps you stay prepared and manage potential volatility around key releases. Thank you for joining me for day 28. Tomorrow we will explore how to manage risk when markets are highly volatile, which is a valuable skill in uncertain times. Until then, keep tracking those indicators and stay informed and trade with a clear purpose. Happy trading. And tomorrow we'll dive into the role of technology and trading tools in the modern trading. Thank you everyone.